Backdoor Roth contributions are a great tool to get money into a Roth IRA, especially when your income is too high. Now, there is a bit of a wrinkle, though, where the IRS will hit you with an extra tax if you're not careful. So, I want to describe what that pro rata rule is and how it works. Using an example with a client that I've worked with, where he has money in an old 401k, about 135,000 or so, and he hasn't rolled it over precisely because of this rule. But let's assume that he did, and it's sitting in an IRA. Now, when he goes to make this $7,000 backdoor Roth contribution, that money is all after tax. And what most people expect is that when you do the conversion and complete that process, that you're not going to be taxed on it because it was already taxed before. Well, in this situation, though, when you have money in a pre-tax IRA, the IRS looks at all of that IRA money, and this includes also simple and SEP IRAs as well. So there's $142,000 that the IRS sees, 135 is pre-tax, $7,000 is after tax, roughly about 5% after tax. So when you do the $7,000 contribution to get it into your Roth backdoor, that conversion is going to be 95% taxable, and only the 5%, that 7,000 out of 142, is going to be tax-free, which is roughly about $350. So as you can see here, you got this phantom income, as it were, that you haven't taken home. You haven't moved any money out of the pre-tax IRA, and yet you're having to pay taxes on this conversion. Now, how can you avoid the pro rata rule? You got basically two options. One is to get money into a 401k because the IRS doesn't count that money against you. The other option is to do a full conversion of that pre-tax IRA. And obviously the caveat there is you're going to have a pretty hefty tax bill for this year. So going back to the other option with the 401k, if you're in the process of changing jobs, you want to make sure that where you land, that there's a 401k plan there that will allow you to either roll the old 401k in or roll in any IRA money that you have outside of work into that plan. And because if you're over that income threshold and you're going to have to do these backdoor Roth contributions, you're going to get hit with that pro rata rule. So little sneaky rule there that where the IRS likes to make things difficult for us. But this is, if you know what to expect, then you can plan ahead and avoid getting taxed on this phantom income, which is going to feel like you're being double taxed.